Hello, everyone, and welcome back to the Crypto Visionary Network.
Great to be here.
Today, we're diving headfirst into something that's really flipped our ideas about money and tech completely upside down. We're talking about Bitcoin. You've definitely heard the name, right? Seen the headlines. Maybe your friends won't stop talking about it. But what is it really? Like, how does it actually work? What was the original plan, and maybe what has it become now?
Yeah, that's exactly what we're tackling.
Nice.
For this deep dive, we're sort of cutting through all the noise. We've looked at everything from the original white paper Satoshi wrote to current market analyses.
Right.
The goal is really to give you a clear, straightforward understanding of Bitcoin. We'll start with the basics and then get into some of the more surprising details. Hopefully you walk away feeling, genuinely well-informed.
Exactly. Our mission is to shed some light on this fascinating asset, look at the facts, but also maybe the bigger picture implications. But before we really jump in, just a quick but a really important note, the information we're sharing today, it comes from lots of different internet sources, and it's been compiled using AI.
That's right.
And while we always aim for accuracy, mistakes can happen, misinformation is out there. So please remember, nothing we discuss here is financial advice. It's purely for education.
Absolutely. Always do your own research.
Yeah, do your own digging, use your common sense. Okay.
Right.
So let's start right at the beginning, the origin story. Bitcoin. It all kicks off back in 2008. There's this mysterious figure, maybe a person, maybe a group, nobody really knows for sure, known only as Satoshi Nakamoto.
The legend.
Right. And they dropped this revolutionary idea for a decentralized digital currency. The whole point was to let people send money directly to each other, peer-to-peer, completely cutting out the banks, the traditional financial middlemen.
And what's truly, I think, revolutionary about that initial vision is the concept of an electronic cash system that just completely removes the need for any trusted third party.
Yeah. No middleman.
Think about it, right? Every time you use a credit card or send a wire transfer, there's always a bank or a payment processor sitting in the middle, checking things, taking a cut.
Verifying everything.
Yeah. Satoshi wanted digital money, pure and simple. That can just go from me to you instantly without needing anyone else's permission or involvement. Which, of course, immediately brings up a huge question.
Which is?
Well, if there's no central authority, no bank watching over things, how do you stop fraud? How do you stop someone from just, copying the digital money and spending it twice?
Right.
Or just making fake money?
That's the million-dollar turn, isn't it? If there's no bank, how can you possibly trust the system? How does Bitcoin actually solve that?
Okay, so it does it through this really clever idea called a distributed ledger.
Distributed ledger.
Yeah, imagine instead of one central record book held by a bank, you have thousands, maybe tens of thousands of identical copies of the same record book.
Wow. Okay.
And these copies are spread all across the globe on a huge network of computers. And they're all constantly being updated, together, in sync. Every single Bitcoin transaction ever is recorded in these identical ledgers.
So literally everyone running the software has a copy of the entire history. How does that stop the cheating?
Exactly. Because everyone has a copy, and they all have to agree, it makes it practically impossible for someone to sneak in a fake transaction or to double spend their Bitcoin.
Meaning spending the same coin twice.
Right. You can't send the same Bitcoin to me and to someone else because the network would see the conflict immediately when trying to update all those ledgers. The real backbone making this work is the blockchain.
Ah, the famous blockchain.
Yeah, you can picture it like a digital chain, right? Each block in the chain is like a page in that shared record book. It's filled with a list of recent verified transactions.
Okay.
Once a block or a page is full, it gets sealed. It's given this unique digital fingerprint, that's the cryptographic hash, and then it's mathematically linked to the previous block in the chain.
Creating a chain.
Exactly. An unbroken, verifiable chain stretching all the way back to the very first Bitcoin block, the Genesis block.
And that digital fingerprint, the hash, you said, if someone tried to mess with an old transaction, change a number somewhere.
Ah, good question. That's the beauty of it. That hash isn't just random. It's generated from all the data inside that specific block, plus a piece of the hash from the block before it.
I see.
So if you change even one tiny detail in an old transaction, the hash for that entire block changes completely.
Which breaks the link.
Which instantly breaks the link to the next block because the hashes won't match up anymore. The whole chain after that point becomes invalid. It makes any tampering super obvious to everyone on the network. It's immediately rejected. There's also something called a timestamp server involved.
Okay, what does that do?
It basically takes that hash of a block of transactions and widely publishes it, proving that that specific data existed at that exact time. Can't backdate anything.
So, tamper-proof and time-stamped. That covers securing the past transactions. But the big question for a lot of people is, where do new Bitcoins actually come from? And how do new transactions get verified and added to that chain in the first place?
Right. That brings us to Bitcoin mining.
Mining.
This is the process that does two critical things.
Mm-hmm.
It introduces new Bitcoins into circulation, and is how new transactions get confirmed and essentially added to the blockchain. Miners are kind of like the network's accountants and security guards all rolled into one.
Okay, accountants and security guards, but what does mining actually involve? We're not talking pickaxes and digital caves, right?
No, not quite. Unless maybe digital pickaxes count. Miners use really specialized, super powerful computers. Often these are custom-built chips called ASICs.
ASICs?
Application-specific integrated circuits. They're designed to do one thing, and one thing only, extremely well. Solve incredibly complex cryptographic puzzles. Yeah, you can think of it like a massive global lottery happening roughly every 10 minutes. Miners are all competing, using their computing power to try and be the first to find the solution to this puzzle.
And what happens when they find it?
The first miner to crack the puzzle gets the right to create the next block, fill it with pending transactions they've gathered, and add it to the official blockchain. And for doing that work, that computational heavy lifting that secures the network, they get a reward.
Ah, the reward.
Exactly. They receive a certain amount of brand new Bitcoin, which didn't exist before, plus any transaction fees people included with the transactions in that block. This reward is the incentive part.
So it pays them to help secure the network.
Precisely. It encourages people to dedicate serious computing power and, significant electricity to keep the network running, verify transactions, and make it secure. It's incredibly competitive now. The chance of any single miner finding the solution is basically proportional to how much computing power they have compared to the total power of the entire network.
Requires serious hardware then?
Oh, yeah. Mostly those specialized ASICs these days. It's not something you can easily do on a regular laptop anymore.
And you mentioned earlier, you don't have to buy a whole Bitcoin. They can be split up.
Absolutely. That's crucial for usability. While one Bitcoin might be worth, a lot, it's highly divisible. You can own just a tiny fraction. The smallest unit is called a Satoshi.
A Satoshi, after the founder.
Exactly. And one Satoshi is just 0.000000001 BTC. So there are 100 million Satoshis in a single Bitcoin. Makes it accessible. You can send very small amounts if needed.
Okay, so Bitcoin started with this vision, peer-to-peer electronic cash. But it feels like the story, the narrative around it has shifted quite a bit. Now you hear it described more as digital gold or a universal store of value for the digital age. What's driving that? What makes it attractive in that way?
Yeah, that's a really interesting evolution. If we sort of zoom out and look at the bigger picture, the investment case for Bitcoin often highlights a few key things. First and foremost is its decentralization.
Back to that again.
It's fundamental. It's not controlled by any single entity. No central bank, no government, no corporation. This means, in theory, no one can just decide to freeze your account or censor your transactions or suddenly print a whole lot more of it and devalue what you hold.
Right. It's resistant to that kind of control or confiscation.
Exactly. It offers a form of financial sovereignty. And the security of the network itself isn't based on a trusted company. It's based on the massive amount of energy, the computational work spent by miners. That proof of work is hard to fake or undo, which gives the network inherent value and resilience.
That's a huge contrast to traditional currencies where governments can and do just print more money whenever they feel like it.
Precisely. And that leads directly to the second point. Bitcoin as sound money. Unlike those fiat currencies, which can be inflated away over time, Bitcoin has a mathematically enforced limited supply.
The 21 million cap.
Only 21 million Bitcoin will ever exist. Period. That scarcity is hard-coded into the protocol. It can't be changed easily. This makes it attractive as a potential store of value, something that might hold its purchasing power over the long term, like gold is supposed to.
And that scarcity gets tighter over time because of the halvings, right?
Yeah. The declining inflation rate is built in through those halving events. Roughly every 4 years, the block reward, the amount of new Bitcoin given to miners, gets cut in half.
So fewer new coins are created over time.
Exactly. It incrementally reduces the rate at which new supply enters the market. Historically, these halving events, by constricting supply while demand potentially grows, have often preceded significant price increases. It's a core part of its deflationary design.
Interesting. What else makes it appealing as an investment or store of value?
Well, there's also its historical diversification and return profile. Looking back, Bitcoin has often shown a relatively low correlation to traditional assets like stocks or bonds.
Meaning its price doesn't always move in the same direction.
Right. Which can be valuable for diversifying a portfolio. And it's exhibited what's called an asymmetrical return distribution, meaning the potential upside has historically been much larger than the potential downside, although past performance is no guarantee, of course. Some analyses suggest that even adding a very small allocation, like maybe 1% to a traditional portfolio, might have significantly boosted overall returns over certain periods.
A potential performance enhancer, even in small doses.
Potentially, yes. And finally, there's the idea of universal adoption. Bitcoin's network is global, it's borderless, anyone with an internet connection can potentially participate. And its adoption, while still relatively early, has been growing steadily worldwide, which supporters believe strengthens its network effect and its claim as a global store of value.
It definitely sounds like the community, or at least a big part of it, truly believes in this digital gold idea.
Yeah.
You even hear calls to stop measuring Bitcoin in fiat, like it should be its own unit of account.
There's certainly a sentiment among strong believers, yeah.
But okay, it can't all be smooth sailing. Like any technology, especially one this disruptive, there have to be downsides, criticisms, real challenges it faces. What are the big hurdles for Bitcoin?
Oh, absolutely. The vision is grand, but the reality is complex. The whole code is law idea sounds great, promising a perfectly self-regulating system, but it doesn't always play out so cleanly. And unbacked cryptocurrencies like Bitcoin have definitely faced, real hurdles in becoming truly mainstream money. One of the biggest technical challenges is scalability and efficiency.
Right. Does that mean it just can't handle enough transactions fast enough for, say, buying coffee?
Pretty much, yeah. Transacting directly on the main Bitcoin blockchain, especially during busy times, can be relatively inefficient, slow, and expensive. The network can only process a limited number of transactions per second, far fewer than, say, Visa.
Correct.
This ties into something called the blockchain trilemma.
The trilemma sounds tricky.
It is. The idea is that it's incredibly difficult for these decentralized systems to achieve optimal security, scalability, meaning high transaction speed and low cost, and true decentralization all at the same time. You usually have to make trade-offs. Bitcoin prioritizes security and decentralization, which historically has come at the cost of scalability on its base layer, though there are solutions like the Lightning Network being built on top to address this.
So speed is an issue. What else?
Well, the big one everyone talks about is price instability and market risk. Let's be honest, Bitcoin has seen absolutely wild price swings over its short existence.
Understatement of the year sometimes.
Right. There have been massive run-ups, but also incredibly sharp drawdowns, losing huge percentages of its value in relatively short periods. This volatility makes it difficult to use as everyday currency and risky as a short-term investment. It's highly sensitive to news, regulatory whispers, macroeconomic events, and ironically, that limited supply we mentioned is a strength. It also means Bitcoin does not offer protection against the risk of structural deflation if the wider economy were to head that way.
And what about the environmental stuff? We hear a lot about the energy use.
That's another major point of criticism, the environmental concerns. Bitcoin mining, that proof-of-work process, consumes a vast amount of electricity.
How fast?
Some estimates put its annual energy consumption on par with entire medium-sized countries. This has led to significant debate about its sustainability and carbon footprint.
Are there counter-arguments to that?
Yeah, proponents argue a few things. One, that a growing percentage of mining uses renewable energy sources. Two, that miners are incentivized to find the absolute cheapest power, which sometimes means using energy that would otherwise be wasted, like flared natural gas. And three, that the energy is well spent securing a potentially revolutionary global financial network. But the debate is definitely ongoing and intense.
Okay, energy use is a big one. What about governments and regulators?
Regulatory risk. This is a constantly shifting landscape and a huge source of uncertainty. It varies massively around the world. You have El Salvador making it legal tender, which was huge.
Right.
But then you have places like China, which have cracked down hard, barring banks from dealing with crypto transactions back in 2013 and later banning mining. Thailand also briefly banned it in 2013. In other major economies like the US, the EU, the UK, Canada, it's this complex patchwork of evolving rules. The EU has MyCar, its comprehensive framework. The US is still figuring things out, agency by agency. Is it a commodity? Is it something else?
Is it a security? That's a big question in the U.S.
Exactly. As of late 2024, the official stance from U.S. authorities like the SEC seems to be that Bitcoin itself is not a security, more like a commodity. But that could always change. And regulations around exchanges are definitely tightening globally, focusing on things like anti-money laundering, AML laws, and the travel rule, which requires exchanges to share sender and receiver information for transactions above a certain threshold. Even the legality of mining itself differs from place to place.
So a lot of uncertainty there. And what about security for the average person holding Bitcoin? Is the blockchain hackable?
The blockchain itself is considered extremely secure, practically unhackable, due to its decentralized nature and the massive computing power protecting it. However, that's not usually where the problems lie for individual users. The main security and fraud risks come from how people interact with Bitcoin.
Like the exchanges.
Exactly. Most people buy, sell, and often store their Bitcoin on centralized exchanges. These are digital platforms, essentially websites or apps, and like any online service, they are at risk from hackers, malware, and operational glitches. We've seen numerous high-profile exchange hacks over the years where customers lost funds.
And your funds aren't insured like money in a bank, right?
Generally, no. Bitcoin and other cryptos aren't typically covered by government deposit insurance schemes like the FDIC in the US or similar programs elsewhere. Some exchanges might offer their own private insurance, often through third parties, maybe covering losses from system failures or hacks on their end, but it's not the same guarantee as traditional banking. Plus, there's always the risk of phishing scams, malware designed to steal your private keys, and other forms of fraud risk targeting individual users.
So user security is paramount. You mentioned something interesting earlier, too, about centralization, despite Bitcoin's decentralized ideal.
Yeah, this is a fascinating, maybe even ironic trend. While the network protocol itself is decentralized, the activity around Bitcoin has become somewhat concentrated. One source estimated that since around 2015, approximately 75% of the actual Bitcoin volume has been associated with exchanges or exchange-like entities.
Wow, 3/4.
Yeah. So while anyone can run a node or transact peer-to-peer, a huge amount of the economic activity flows through these centralized platforms.
Yeah.
It led one source we saw to state quite bluntly, Bitcoin's original vision has been surpassed.
Surpassed. That's a strong statement, suggesting maybe it failed in its original goal of pure peer-to-peer cash.
Or perhaps just evolved into something different, depending on your perspective. But it definitely highlights a tension between the decentralized ideal and the practical realities of how most people interact with it today.
Okay, so despite all these challenges, scalability, volatility, regulation, centralization trends, Bitcoin has undeniably built this incredibly vibrant global ecosystem. Just how popular is it now, and how are people actually using it in the real world?
It's definitely global, and adoption continues to grow. We already talked about Satoshis making it accessible. People buy and sell it easily on countless exchanges worldwide. Or yes, they can still trade it directly peer-to-peer if they choose.
And usage beyond just speculation or holding it as digital gold?
Yeah, it is used. International transactions are a common use case, sometimes offering lower fees or faster settlement than traditional bank wires, especially for smaller amounts or in regions with less developed banking. Some forex trading platforms accept it for deposits, which can be quicker and avoids sharing bank details.
Makes sense. What about some of those early milestones? When did it start to feel like it was gaining real traction?
The timeline shows a pretty clear progression. 2011 was big when WikiLeaks started accepting Bitcoin donations after being cut off by traditional payment processors. That really highlighted its censorship resistance.
A political statement, almost.
In a way, yeah. Then by 2012, BitPay, which helps merchants accept Bitcoin, already had 1,000 businesses signed up. 2013 was a huge year. Coinbase reported selling over $1 million worth of Bitcoin per month. The Internet Archive started taking donations. That first Bitcoin ATM popped up in Vancouver, making it suddenly feel more tangible.
Right, you could physically interact with it.
Yeah. A university in Cyprus even started accepting Bitcoin for tuition fees. And major online retailers like Overstock.com announced plans to take it. By 2014, you had the gaming company Zynga testing it, Tiger Direct accepting it, even some Las Vegas casinos getting on board. It wasn't just niche anymore, it was pushing into the mainstream consciousness.
Those are pretty significant steps for something that started as just a white paper from an anonymous author. What about key moments on the regulatory side, showing how authorities were starting to grapple with it?
Regulation has been this constant back and forth, a real dance of uncertainty, but also gradual legitimization in some areas. Back in 2013, FinCEN in the U.S. issued guidance clarifying that just using Bitcoin didn't make you a money transmitter. But if you were mining and selling it professionally, you might need to register.
Okay. Distinguishing users from businesses.
Right. The same year, Germany took a step by classifying Bitcoin as private money, giving it a sort of legal status, though not making it legal tender. We mentioned China barring banks in 2013. Then you fast forward to 2021, that landmark move by El Salvador, making it actual legal tender alongside the U.S. dollar.
That sent shockwaves, didn't it?
Absolutely. Also in 2021, another interesting development was the U.S. Department of Justice recovering millions in Bitcoin paid as ransom in the Colonial Pipeline hack. That showed that, despite its reputation for anonymity, transactions can often be traced on the public blockchain, and law enforcement was adapting.
So not quite the Wild West anymore.
Increasingly less so. And looking ahead, you have major established financial players like the Chicago Mercantile Exchange, CME, and the Chicago Board Options Exchange, CBOE, launching Bitcoin futures contracts years ago. And now we have Bitcoin ETFs in the U.S. That really signals a deeper integration into the traditional financial system.
Wow. What an incredible, almost whirlwind journey we've just traced. We went from Satoshi Nakamoto's really quite radical vision for peer-to-peer electronic cash all the way to Bitcoin's current complex role as this decentralized digital asset valued by many for its scarcity, its digital gold properties. We've touched on the ingenious blockchain technology, the clever incentive system for miners, and this roller coaster ride of adoption, regulation, and price swings across the globe.
Exactly. And it's clear that while Bitcoin offers these really unique advantages, censorship resistance, a potential hedge against traditional monetary inflation, it's also wrestling with pretty significant challenges. Price volatility is still huge. Scalability on the base layer remains a limitation. Those environmental questions aren't going away, and the regulatory picture is still being painted differently all over the world.
So, pulling it all together for you, the listener, what does it all mean? Bitcoin is still very much a dynamic, heavily debated, and undeniably influential force. That question lingers. Has its original vision, that pure peer-to-peer cash system, has it really been surpassed, like that source suggested?
Perhaps evolved.
Or has it evolved into its true destiny, maybe, as this new kind of digital store of value finding its niche in the global financial landscape?
Yeah.
It's still an open question, really.
And that actually brings up, I think, a really interesting, maybe provocative thought to leave people with, related to that centralization trend we discussed.
Oh, yeah. What's that?
Well, if the original promise of crypto, not just Bitcoin, was fundamentally about replacing trust in institutions with trust in technology and code.
Right. Trustless systems.
Exactly. But then we observe this strong tendency, especially in how Bitcoin is traded and accessed, towards centralization, relying on these big exchanges, these intermediaries. What does that actually imply for the future of true decentralization? Not just in finance, but in this whole digital age we're building. Are we inevitably drawn back to trusted third parties, even when the technology offers an alternative?
That is definitely food for thought. Were we rebuilding the old systems on top of the new rails? Fascinating question.
Something to ponder.
Absolutely. Well, on that note, as always, please remember everything we've discussed here is for educational purposes only. It is definitely not financial advice.
Please do your own research.
Yes, absolutely. Do your own homework, use your common sense, think critically, and keep that curiosity going. Until our next deep dive here on the Crypto Visionary Network, stay informed.